see here. Okay, so one of our attendees, I'm sorry, that's online today, had a question about a covered collar sort of radioactive trade position that they were in. I wanted to see about ways of maybe managing that position as well. Okay, well, let's break down the current position. To do that, we're going to go into the custom spread tool on our Power Options webinar account. What you're looking at right here, of course, the webinar account is the same as what you'd see on a 14-day free trial. And for those of you that are currently on a trial account, I want to encourage you to take advantage of the 4 steps that are listed here to get more familiar with the tools on the site to help you get a jump start on using the tools during your trial period. All right, but let's go over to our custom spread tool. Now, the way the customer described the position to me is they currently had a gain on a position for GDX, the gold miner there. And there was 100 shares of stock owned at about 22, I think 68. Now at the same time, after the GDX had moved up a little bit from the initial purchase price, the investor had sold an April 24.5 strike call for 61 cents, if I'm not mistaken. Okay, so we'll go into April for the options here. We had a 24.5 call, currently priced around 16 to 17. But back when this position was sold, the price was 61 cents. Now, it should come out to about 11% return if assigned on the covered call. Okay, there we go. So this was the current position. Now, with the premium in hand, the 61 cents, if the stock was trading above 22.68, we'd realize a return of 11%. Of course, we paid 22.68 for the stock, received a 61 cent premium for selling that April 24.50 call. So the total out of pocket, if we did 100 shares, was $2,207. That also represents the risk. Now, GDX is not likely to go down to $1 per share or $0 per share. If it does, we've got a lot more concerns going on in the world economy and in the market than just seeing this position go down to $1 per share. But it is true that in a covered call, your maximum risk is equal to the outlay of the stock minus whatever premium you receive. Now, the investor wanted to insure this position, okay? And what they wanted to do is follow the radioactive trading techniques where we typically buy a far out in-the-money put option to control some of the risk. Now, with the cost basis at $22.68 and the current price at $23.45, my temptation, if I was in this covered call and wanted to insure it long-term, maybe continue writing calls against it and have a good protection, I'd want to keep the put strike price below the current call price that I sold. Okay? If I buy a call, if I buy a put at a higher strike price, I'm actually going to create a bearish position. Right? So if I'm still bullish, but I want to insure the position in case something goes wrong and I want to have long-term insurance, I might look farther out in time, and the customer went out to January. Now, my first instinct would be to go to the 24 put with a price of around $3.15, maybe the 25, but again, I don't really want to buy a put that's above my short call strike price. So let's go ahead and take a look at the 24 put at a price of $3.10 or $3.15, midpoint at $3.15. So I'm adding to the cost basis of the position. Still the 61 cents I generated coming into the position, and I have a lower cost basis at $22.68. So in this case, we'd still have a risk on the position. Took away from some of the potential profit in April, but we do have insurance out to January. The max risk is only $122 per 100 shares, or 4.8%. And that's really if the stock fell distinctively down below the $14, $12, or $10 range. Okay? So we took away some of the potential profit above 24.5, and because of the increased cost basis, now at $25.22, we do have a chance that we could lose on the upside if the stock really gapped up. I should say ETF. I keep saying stock, but I should say ETF as well. Okay? All right. Now, that being said, what the investor did is to get better protection, they bought a deeper in-the-money put option. But there's a rule about going too far in the money. And in this case, the investor went out to the 39 put, more than 50% in the money, and I believe paid $15.20 for the put option. All right, now, what are the pros and cons here? Well, the pros and cons is the max risk does go up. It almost quadruples to 30, almost 10 times, up to 34% to the upside now. So if this ETF gaps up in price or it moves quickly, the loss is to the upside. Why? Because the cost basis of the stock plus put combination is so high, 37.27, but we've entered an obligation to deliver shares of stock at 24.50. When we lower the risk or cancel the risk on a standard married put position, we consider that to be bulletproof. And that means that even if the stock fell, we'd have no loss on the position. Is this position bulletproof? Well, it has a positive gain of 5% to the downside, but it's not bulletproof because we could still lose money to the upside because we created such a bearish position. But what's interesting about where the customer is now, they paid $15.20 for that 39 put. GDX has since pulled back, so we can actually sell to close this put. Earlier it was at a midpoint of about $15.70, but right now it looked to be as about $15.60 when I saw it. But we could sell the put and take 40 or 50 cents premium. So let's go to January. There's that 39 put. It's about a 25 cent, bid-ask spread from $15.50 to $15.75. So if we add that back in, and we're going to sell to close that put for, let's say, okay, $15.60. So we'll gain about 40 cents of premium. Maybe we'd get $15.65, but we'll say $15.60 and take in 40 cents of premium. Okay, so we made a profit on the put. We've lowered our cost basis down now to $21.67, and as the covered call stands, we'd have a 13% return. Now, of course, to complete this transaction, this radioactive trade, I could go in and buy that 24 put again. We see the price now at 305 to 315. We'll call it 310. But it's going to be less for us because we also took in this 40 cents. So really we're only paying about $2.70 for this put after this transaction here. So now we lower our risk to 2.1%. We could still make 9.4% if the stock's trading at that price. Now, why is it important to keep this strike price, after buying at a later date if the stock moves up, to keep it near where the current stock is? And the reason why is because it's easier now to perform other adjustments. If the stock stays where it is at 23.50, that 24.50 call will expire worthless. We'd lower our cost basis on the stock down to 22.07, right, if we keep the full 61 cents. Okay, so now we're left with a position that again still has that lowered risk, only $77. But if I have the 39 put, you saw what would happen if we sold the 24, the 25, or the 26 call. We'd create that bearish position. Now that I'm holding the 24 put, we could go out now and maybe, let's say, at April expiration, we could sell the May 24 call. Let's say we only get another 60 cents or 65 cents for it. Now we're pretty much close to canceling the risk on the position, still have the potential for around an 11% return. But even if the stock falls, there's no real risk, no real chance of loss, and we're also protected all the way out to January. So this position could still be managed effectively. Even though at this point the put was bought too deep in the money, there is a small gain on it. We could move the put down to a better strike. We could continue the trade, and in the next 4 to 5 weeks, this position could be at no risk and still have the potential for further upside going forward as well. All right, Todd, so that was sort of what we were looking at on your position earlier. When you buy the put too deep in the money, especially if you already have a call sold against it, you create a bearish position. Okay, so if you're bullish on a position, you never want to buy a put that's above your short call strike price. You don't really want to buy a put that's more than 10 or 15% in the money when you open a radioactive married put to begin with. And if you already have a gain on the stock and you're looking to lock in some of that gain, you want to buy a put that's maybe right at or one strike in the money as well. Okay, now, here's a question from Patrick that just came in, and I'm not sure I fully understand it. Oh, sorry, I went the wrong direction. Here we go. Patrick says that I assume that you can mix in the money, at the money, and out of the money strategies with different stocks. Not the same stock or change in the middle of the trade. Does that more complicated for a beginner, and would you suggest staying with one strategy? Okay, if you're just getting started, I'm staying with one strategy. If you're just getting started in options, Patrick, I would stick with one strategy. Now, you're asking, can you mix in the money, at the money, and out of the money strategy with different stocks? Okay, and you're just getting started. So I'm assuming what you might be referring to, Patrick, is covered call positions. Okay. Okay. Yeah, you're talking about covered calls because you had a follow-up question. Okay, now let me think of a good stock here. I had one earlier today, and I forget what it was. I'm going to go to an option chain. We're just going to look at a call chain for, I don't want to do DKS. I'm just going to pull up Starbucks just for the sake of argument. So let's go to the chain. And what I'm going to do is just go to calls only, and I'm going to go out to April 21st, 14 days away. This isn't really a great chain. Let's do something a little bit better. Oh, why not? We'll go Amazon for the time being. I know you did mention Amazon in your follow-up, I believe. Yeah, Amazon or Tesla. So let me try Amazon, okay? Now, many of us might not be doing a covered call on Amazon right now with a stock at $894.88. We might be looking more at maybe a calendar spread. But what I want to, yeah, I'm going to go further out. I'm going to go to standard May expiration. I apologize. I want to see some good numbers here, and I'm not really seeing what I want. Now I am. Okay, so here's the idea. We know that Amazon right now is trading at $8.94. We could call it $8.95, really. All right, so any of you who are just getting into covered calls that are just starting out, the $8.95 strike is the at-the-money call. But for any stock position at the money, what does it offer you? It offers you what's called the highest time value. So here the price is $31.85 by $32.70. Now as we go in the money, the prices increase, but most of that is becoming intrinsic value. At the 880 strike, we see a bid of 40 and an ask of 41.25. Well, this option is roughly 15 points in the money, so the time value, the true profit here, is only $25. At the money strike, it's about at 32. And as we go out of the money, further above the stock price for our covered calls, we see the time value is decreasing. There's no intrinsic value here. The whole premium is just the time value, and that's decreasing as well. So the at the money gives you the best time value. Doesn't mean the best return. We can't calculate which strike would give us the best return to May expiration unless we know what the stock's going to be trading at May expiration. So, and your question, Patrick, is it okay to go in the money, at the money, and out of the money if you're creating sort of a covered call portfolio and you're looking at various stocks? Well, I think that's okay. See, when I sell in the money, I had an investor ask me about this today. With a stock at $8.95, why would I ever sell an $8.80 call that's below the stock price? Okay, well, the reason why I'm doing it is although I'm giving up 15 points from the stock to where I agreed to deliver the stock at $8.80, I'm getting paid a higher premium for that. I can still make a 2.9% return if I'm assigned. So if at May expiration, Amazon is above $8.80, I get assigned, and the return would be 2.9%. I also have a 4.5% downside protection. This shows me how far the stock can drop before I'm technically losing money on the position. Okay? So as you go in the money, you get higher downside protection, but a lower percent return if assigned. It's a trade-off. I also have a higher probability of getting assigned at $8.80 and making this 2.9% return than, say, selling the $9.20 for only $20.60, potentially making 5.2%, But that 5.2% is considering the growth of the stock from 8.95 to 9.20. So I need the stock to move up 25 points. Then I'd realize the 5.2% if assigned. And I'm only giving myself a 2.3 downside protection. And of course, at the money is sort of like Goldilocks and the Three Bears. The in the money is conservative, and you're willing to give up return to have a higher probability of receiving that return. It's safer while still looking for some return, but you're giving up return, the definition of being conservative. The out of the money, selling a call above the current stock price, out of the money covered call, gives you less protection and a higher potential return, but that only occurs if the stock moves up. It's more speculative. So inside the covered call strategy, this would be considered aggressive. Out of the money is aggressive, in the money is conservative. At the money here, the 8.95, where I have a 3.6% downside protection and a potential for 3.7% return if assigned, this is sometimes considered just right. Okay, so it's not too conservative, it's not too aggressive, but if you're not married to the stocks, you don't mind them being called away, and you're looking at it to try to make a consistent profit of 2 to 2.5% every 30 to 40 days, you're probably going slightly in the money with your covered calls. If you're unsure of the market, but you think we're in a bullish trend and you like the premiums, that's when you're at the money. Out of the money will be used if you're very aggressive, kind of speculative on the market, or if you own shares of Amazon at a lower price and you're looking to just generate a dividend-like income on a weekly or monthly basis, then you'd be selling out of the money hoping the stock doesn't reach this price, this call expires, and you're continuing to lower your cost basis on the position. Okay, so that's sort of a breakdown related to covered calls of in the money, at the money, and out of the money. Okay, and Patrick has a follow-up question, I believe, is how long? Okay, I'm sorry, okay, there we go. How long should you roll up and out on a stock? For instance, Amazon and Tesla that have recently been purchased at a much lower price. Is this rolling limited by trade management rules and getting into trades are very far out to have a slight credit? Okay, so what Patrick is referring to here, I'm going to rephrase the question, Patrick, a little bit differently on your follow-up question here in regards to rolling a covered call. Okay, I'm going to talk about two things here. Now let's say that I had originally bought Amazon at $8.50. Okay, so I have a purchase price of $8.50. And as the stock moved up, we sold the $8.60 call for, let's say, $25. Maybe we did it a week ago, maybe we did it 3 weeks ago. We're just going to plug in some numbers. Okay, so we own the stock at $8.50. We sold an $8.60 call at $25 for April expiration. Okay, what Patrick's asking is, well, if I'm looking to roll the position because I want to stay in the stock, do I have to roll further out in time, maybe to September or October, in order to roll for a credit? Well, let's take a look. So we have Amazon, and we purchased 100 shares of stock for $850 roughly. At the same time, a little bit later, as the stock moved up, sometime before April expiration, we sold our $8.60 call for $25. Now, believe me, I'm not playing with this amount of money either, but let's just use this as an example. This would apply to any covered call position. If we bought an $85 stock and sold the 86 strike call for $250, and now it's trading at $89, that's still the same kind of relative approach we're taking here. It's just the numbers are a little bit bigger. All right. So here we are, we're in the money with our call. The stock's at $8.95 roughly. We're 35 points in the money. We have a potential return of 4.2% for, let's call it a 30-day trade, if our stock stays above $8.60. But we want to stay in the position. And in order to roll this call, the first thing I have to do is take a look and buy back the $8.60 call for April, And we see we have a price of $37.90 to $39.20. So let's call it about $38.60 is the buyback. Okay, so this one might not be too big of an issue. So we have a difference here of $13.60. And with the stock at $8.95, I might want to roll out 2 weeks. Let's call it to the May 5th expiration. And I want to look at maybe the 900, the 905, or maybe the 910. So here it's not a problem. I can roll for $25, $22, $23. All I needed to cover originally was that $13. Okay? Difference between what I collected and what I made. So this one's not a problem. But let's say originally we only collected $12.50. So now I need about $26 in premium. But I want to stay right at the money. Okay? So my target is 910. So if you want to roll for a credit, do you have to go out to May? Do you have to go out further in time at 910? Yeah, you'd have to go further out for a credit to get the $26 back. I'm going to give you 2 schools of thought, and I don't have any guidance for which one of you is best, and which one is best, and you have to decide that for yourself. Ernie, who's been trading much longer than me, trained me on options and most of the things that I do. When he looks to roll a call, he does try to roll it for a credit. I typically don't roll for a credit. The reason why is because I don't like rolling a call to an expiration that's 3, 4, 5, or 6 months away from where I am right now. You get the best annualized return when you sell month by month or week by week. And even if I roll for a debit, and let's say I did roll up to the 910 in this case for a debit here, because I'm paying, I'm paying about $26 back, and these are fake numbers, of course, but I rolled to the 910 and only got 25. The thing is that because of the increase in the price, I'm rolling here for a debit of $13.60, but remember I collected $12.50, so my debit's not that large, and I'm rolling up to a price. So now if I get assigned at 910, my return is increasing. And if my goal was to make 2 to 2.5% every 14 days, or let's say 2%, 2.5% every 30 days, by moving from April to May, I increased my return from that 4.2 to potentially 6.8. So I am still meeting my goals for my trading plan. So do you have to roll for a credit? No, you don't have to. Do you have to make sure that the new option that you're rolling to increases your return that matches your goals? Absolutely. When does this come into play? Let's say that there was something a little bit different. And what I mean by that, along the lines of who was our favorite fun stock of this week that most of us missed, or in the last 3 weeks most of us missed. Let's talk about Panera. Okay? Let's look at an example on Panera. I'm just going to go to the quotes. We know it's at 312 now. But after the sort of buyout that was offered here, we see that a couple weeks ago they were at 255, and now they're up to 315. This is within a 14, 15-day period. Okay, so let's go back to March 25th, for example. Okay, so here on my screen, on the quotes page or on the option chain, I'm going to go historical. We're going to go back to March, I don't know, let's call it 24th. Okay, see where we are. Perfect. On March 24th, Panera Bread is trading at $249.48. If I had a lower cost basis on the stock, and I'm going to get to that in a minute too, but if I have a lower cost basis on the stock or a higher cost basis on the stock, doesn't matter. Let's say we entered a covered call on March 24th for Panera, bought 100 shares at $249.48. Now, let's say we sold an at-the-money call to take advantage of the highest time premium at that time. Right, so we would have sold the $250 for April back on March 24th. Let me get the right date here, folks. Okay. So our $250 call, $380 to $460. We're going to call it a $420. Right, midpoint for the $250 April call. Very quickly, let me add this to the portfolio. I'm just going to create a new one. We're just going to call it April 7th webinar here. Let's just say 50,000 on starting on hand basis. Copy that over. Good. Now, I'm going to enter our trade as a covered call. We're doing Panera. Want date to be 3/24, 249, 88? Yeah, 249.48 was our purchase price. We went at the money to maximize the time premium. So we sold the 250 call, not at 61.80. Wow. But at 420. Okay? All right, so let's go to 324 now. Oops, sorry, folks. Fantastic, okay? All right, and okay, let's say I just want to check something. There we go. Okay, so here's our position on Panera. Had we opened it, selling the 21st April 250 call from March 24th. The stock's up 62.52. April 250 call is up 58.70. It would cost us 62.90 to buy back this call. We knew that getting into this position, if we were assigned, we would have made original expected about 2% return for a 14, 15-day trade. Actually, I'm sorry, it's about a 23-day trade. Not too bad. We could have done better, but Panera at the time, slightly lower volatility. Now, one of the features of using our portfolio tool is we can go to the Position Actions menu and select Position Analysis. The Position Analysis tool, as you're tracking any position in the portfolio, gives you a breakdown of your current position. Here's our profit and loss chart. You know, the max return we expect to make is about 1.9%. We're pretty much close to that after 14 days, and if we hold it for the next 14 days, we'll get assigned and earn that return. Usually what would happen is that we would see that there are rollout opportunities that are available where the Power Options tools would calculate what your position would be if you rolled to a new call based on your buyback cost and selling the higher strike. In this case, it didn't calculate any because it's reading it's too deep in the money. There are rollouts that are profitable on this position, but not to a level that would increase it. So let's take a look. There's some hidden criteria in the background, but let's do it manually, Patrick, as we started before. Now I'm in a situation. I want to stay in Panera because I think there's further upside. This thing got away from me like a monster. How do I adjust the position? First, I have to evaluate what my position would look like if I bought to close the call. So let's go into our View Options field. I go to April 250. Now I've got a bid of 61.80 in an ask of 64. All right, so we're looking at a bid-ask spread of about 220, which means at the midpoint we're looking about $63, $62.90, $63. I'm going to go on the high side. I'm going to say we buy this back for $63. All right, now the stock's at 312. If I make this adjustment, if I buy to close the call for $63, my new cost basis would be $308.28 per share. We only got 420, so we're adding essentially 59, 58, 80 into the position. So we've got a new cost basis of $308.28. But the stock's at 312. Okay, so think about it this way. If you have a stock trading at 312 and your cost basis is 308.28, what call might you sell? Well, I'd probably sell the 310 or the 315. Am I going to be able to roll that for a credit? No. But my cost basis is still below where the stock is. Let me go out to May. Let me look at the 310 at 280 to 4, 315. Well, not going to generate 35 cents for it. We're going to focus on that 310. Again, let's call this roughly 350. We'll go to the high side there at the midpoint of 280 to 4. We're going to sell to open this new call at 350. Okay. This is not what I'd particularly do. And this is why we didn't see any in the rollout opportunities. Now, this is not necessarily a bad trade. We're still making a 1.6 return. But remember, Patrick, if I hold this position for the next 14 days, I'm making 1.9% in April. If I roll with this prices, I'm only getting 1.6%. I'm lowering my potential return by 0.3% by increasing the time by 30 days. This would not match my trading plan. I would want this to be up to 2.8 or maybe 3.3% this here to be up around, well, I'll say it, even 3% to maybe 4% in order to make it a viable roll. Now, I'm rolling for a huge debit. That's true. But usually if you roll for a debit, you can see an increase in price. Now, am I going to be able to roll this thing for a credit? Not unless I stay in the money and go far out in time. Okay, so let's take a look. Can we go to August? The only option that's available around $63 is the 250 call we already have. That makes 0 cents. And no dollars. All right, so look at our 310. We could roll this now 450 to 580 for August expiration. I'm sorry, what's the midpoint there? $1.30, so we're talking about 515. So we'll get another dollar or so by rolling to the 310 for August. Call it 515. It would help if I sold that call so we could get the return, only 2%. Okay, higher? Can we go a little bit higher, further out in time? What happens if we did go all the way out to, I'm going to skip November. Let's just, for the sake of argument, go to January. 310 call, $5 to $8.50, wide bid-ask spread. Let's call it 350, 175, I'm sorry. So let's call it 675. We could get the January call for 675. Not a lot to deal with. So this only puts us at 2.1%. All right. Would I get a higher return if I went to 315? Yes, because it's including the $5 extra intrinsic. But is that going to hit that in the next 30 days or so? Let's take a look. I just want to show it real quick. I'm sorry, folks. May, out of the money 315 for 30 cents. Hell of a debit to roll it with, pardon my French. You know, got 420, collected 30, paid back 63. Ouch. Cost base is still at 37.98. There's a 2.2 potential return above the 1.9 we have, but only for 1.9%. This one here, in this situation with this big of a gap, does not give me what I want to match my trading plan. So honestly, what would I decide here? I would probably let this get assigned in April, 14 days from now, with my lower strike at 250. I'm not seeing a good increase in return by rolling up to the higher strike prices. I have no benefit, no way to roll for a credit and keep it at the money because the premiums just aren't there. I could go out to January 2019. I'm not getting $63 for an at-the-money or even slightly in-the-money call. The 300 call won't be worth $63 even out to January 2019. There's no way to roll for a credit. In this case, because there was such a good movement on the stock, we see that even rolling to out of the money doesn't give us a return. But I'll tell you what, if the stock was trading right at 314 and this 315 call had a dollar premium, okay, well, I probably would end up paying more for the April 250, but let's say we could get $1.50 for that call. My return goes up to 2.6%. Still not what I want, but you see where I'm going. If my return right now is 1.9%, and I roll for a monster debit of even $58, but because of the movement of the strike up $65, if my return had moved from 1.9% up to 4% or 3.8%, I'm still making that 1.9 to 2.1% for an extra 30 days of time. That matches my trading plan, and I would be okay with that. I wouldn't force it to roll for a credit and go out 6 to 8 months if the new return at the higher strike price matches my trading plan. Or, in this case, as you saw, I'd probably let this get assigned and then evaluate if I want to open Panera on April 24th, the Monday following expiration, as a new covered call going into May, maybe buying it at 308, selling the 310 or the 305 to get a 1, 2, or 3% return based on my trading plan. I am always hesitant to roll 6 to 8 months out in time just to roll for a credit. We couldn't even do that here, but let's say we had a different covered call scenario where we could roll out to a different strike price, up in price, and we rolled for a credit. I'm hesitant to do that because, geez, a lot can happen in 6 months. Okay? I might be cutting myself short. What do I mean by a lot can happen in 6 months? Panera Bread. A lot can happen in 6 months. This is a great example in the reverse. Okay? Here's what I mean. Let's say about a year ago, 12 months ago, we, as a team, had bought into Panera right here at around, I'm sorry, what number is that? 225. So let's say we bought Panera at 221 and we sold a 225 call for July expiration. Okay, it would have expired. It's not near that. We rolled to another 225 call here. So this is a 225 and this is a 225. And then suddenly the stock drops. Now we're down at this point to about 180. We'd sold the 220, I'm sorry, we still have a cost basis of 221. We've lowered it twice by premium selling the 225. So let's say we have a cost basis of 210 even. Got $11 in credit, which probably we only would have gotten $2 or $3 based on what we're seeing with the at-the-money calls right now on Panera. Let's be more realistic. Let's say we just dropped this down to 215 at this point. So here we are with our cost basis at 215, and the stock's plummeting around 185. So we're 30-point loss, and we're only generating about $1 to $2 every month. So with a 30-point loss, 12 months ago to 6 months ago, even if we're getting $2 in premium, this means we need 15 months of premium to get back to break even at $2, right? So we're down $30 from 215 down to 185. So what are some of the popular techniques? Well, when investors see a loss at this point, there's a covered call instructional guru out there. He has something called a slingshot, where he'd say here, oh, what you want to do is you want to go out to January 2018. You want to roll for a credit and roll about 6 months out in time. So what you would do is sell the at the money or slightly in the money 190 call for January 2018. Okay, so I can't do it on this screen right now, but I am going to do it real quick. So let's say back on end of October, beginning of November, we had a cost basis of 215 on Panera, and we hit this slingshot mode. Okay, so we're 30 points down when the stock was at 185. So we want a premium of $30 to repair this position. Okay, so let me hold that there for a second, and let's go back to our custom spread tool. Actually, I'm going to do something else. I'm sorry, folks. Let me pause this here. And I know there's a couple more questions, folks. I'll be right there. Let me just make sure everyone's seeing what I'm seeing. Good. Okay, you're looking at the portfolio right now. That's perfectly fine. Just give me 1 second. And all right. Sorry about that. Okay. So now here's Panera. We're going to go back to October. I'm going to try the 27th or the 28th here. Let's see where our price for Panera was on October 27th. 189. That's decent. Next day is 194. Okay, so it jumped 484 right after that. But we want it to be at 185, so I'm going to go back a little bit. Maybe it never really dropped there totally. 94. It looks like 189 is the best. Okay, so we're going to stick with the 189 price. I'm sorry. There we go. So let's call it 190. Okay, let's call Panera at 190. We have a cost basis of 215, which is $25 down. Let's go to January 19 expiration just for the calls. And we're pretty much close. So we have a cost basis of 215. The stock's at 189 or 190. We're down 25 points. So let's say we do the out of the money 190 call, and we get 220 for it. Let's say we waited a day. Let's go ahead and do that. Okay, we'll jump back up to 194. So our loss at this point, or it's almost at 195, so our loss at this point would have only been $20, and let's say we get $24 for the 195 call. Now, I don't need to show, we're just going to look at the math, but I don't need to show the math because you guys see the error of this sort of slingshot method, right? At no point before any of this happened at 195 would this have been a lower price where we could have bought it back more cheaply. This thing has just gone up in price. We're handicapped now. So let's look at it at the custom spread tool. We're saying that we had gotten a Panera a year ago, sold a couple calls against it, and lowered our cost basis down to 215. In October, November of last year, the stock fell to about that 189, 190 level. We had a loss of $25. And it came back up to about 195. So to Slingshot, to sell for a credit to cover the loss, we went out to the 190 call for January. Wow. And we collected, let's say on the high side even. No, I'm sorry, we're going to do in the 195. We're going to be nice for ourselves. We're going to do the 195 for 25. Okay, so that was a slingshot maneuver. So we could take a loss of $25 into a potential gain of 2.6%. And now we're in a position where that's all we can make. This option didn't lose value as time went on. We're so far handcuffed by this position, it's going to cost us $120 to buy this back. That's more than 50% of what we paid for the stock. So rolling out for a credit or trying to find a far out option that repairs the amount you've lost right away can be dangerous because, again, a lot can happen in a 6-month time period. Here's the first 6-month loop. Here's the next 6-month loop. Okay? 220 roughly to 185 roughly to 312 roughly. Okay? Not many stocks sit there and do this for a 12 to 15 month period. And if they do, the option premiums are going to be so negligible because there's no implied volatility that it's going to be there. Okay? Yeah. All right. So that's the discussion there we're talking about with rolling covered calls. Sometimes it's best to just let it get assigned and then reevaluate your position. And here's the trick. And you had mentioned this before, Patrick. How do I want to say this? I'm not stuttering. I'm just trying to think of the best way to say this. Let's go back to our original position that we talked about at 249.48. And we sold our April 250 call on Panera. And we received, what did I say, 420? All right. Okay, there you go. So there we go in this position. Now, had I opened this position on March 24th, and I had the potential of a 1.9% return, you know what? I did that because I opened this position because it matched my trading plan. My structure, my goals in this portion of my portfolio are to make 1.9% or so if I'm assigned on my covered call positions every 20 to 30 days. This matches my trading plan. That's why I entered it. If it didn't match my trading plan, whereas if the stock moved up 20%, was I still happy with the 1.9% gain? If the stock fell 20%, was I okay with the management of it? You have to go into every position with that question in your mind. We call it the what-if scenarios or the catastrophe report. Are you okay if X, and are you comfortable if Y? Are you comfortable if 2X, and are you comfortable if 2Y? Okay, so if it drops down twice as much as you originally expected in the worst case scenario, are you still comfortable with the position? No one likes to lose, but we have to have that plan going into the trade. It's part of a trading plan. So at this point, would I evaluate rolling? Yes. Would I feel I have to roll for a credit? Not necessarily. If I could roll up in strikes and for the next 30 days, increasing my time from April to May, if in that next 30 days, I could get another 1.9 or 2% return to match my trading plan. If this went up to 3.9, 4%, or it doubled to even 3.8%, I'd be okay with that. We saw that it didn't. We saw that we couldn't even roll for a credit if we tried, and Patrick, you mentioned too, a lot of times when you try that, if it's too big of a move, you run out of options, meaning there's no options far enough out in time that makes sense to roll to. This case, I was comfortable with it in the trading plan of my portfolio. I might just let it get assigned. In fact, if I was in this trade and this had happened, looking at the numbers, I likely would let this get assigned. I'd take the return of 1.9%. I'd get $25,000 back at getting assigned at 25. I'd have a profit of 472 or 1.9%. But now with $25,000 in hand, true, not much more about the cost base I had, I could open another covered call, another 3 covered calls with $80 stocks, for example. Who knows, okay? Do other positions, but you've made what you expected to make. That's why you'd open the position. If this didn't match your trading plan when you open the position, then why would you have done it? You wouldn't have, okay? So that's where we go back to there. And Sam brings out a point here, but it's gotten me it's gotten me 2 or 3 times in the past 3 months or so. Sam says, never cap your upside in a bullish market. You could be in hell then. That's true. Covered calls, cash secured naked puts, even bull put credit spreads. Sure, they can give you a good leverage return with a bull put credit spread, but you have a capped gain to the upside. Are we still in a bullish market? Well, it looks like it. How much longer is it going to last? I don't really know. But as Sam says, there's a lot of strategies you can use that leave your upside open, keep your risk controlled to the downside, and sort of flipping the covered call. That's what a married put is as well. And speaking of that, by the way, we had talked earlier about the position on GDX. I'll use that as a quick example here. One thing I like to do, now the position we discussed on GDX was a covered call had already been opened on it, and then the investor looked to buy a put to ensure the downside. Typically, if I have a stock position that I'm holding and it has an unrealized gain in it, or maybe I got put the stock from a naked put and it recovered, or I bought a call and it moved up and I thought, this stock's still bullish, maybe I'll exercise it and get into the stock. Well, if I have a gain in the stock, what I'll do first is evaluate what we call the insurance. And what this allows me to do, this insurance tool allows me to do, if I have GDX, let's say, with a cost basis of $22.68 per share, what this tool does is calculate when my unrealized gain is not that high, it's 3.6%. But this tool is showing me put options I could buy right now that would lock in a profit, meaning that I'd be guaranteed at least this return and still have unlimited upside. So for example, with the stock at $23.50, if I bought the the April 28th, let's use this one, $24.50 put for $1.33, I'm going to take my cost basis up to $24 per share, but I'm guaranteed to get $24.50 back right off the bat. So now I have a guaranteed profit of 2%. And I'm holding this, so if the ETF, I keep saying stock, if the ETF continues to move up, I can still realize higher profits, but I can't lose on the position. It could go to $20. I'm still going to make a profit of 2%. And of course, I have an April put in place out to the 28th, so maybe I could do a weekly option at $24.50. It's a terrible premium, but you wouldn't do this. You'd look for a better premium. You'd have to go out to the 21st probably, but we could increase that, by selling at the April 13th, $24.50, mark it up to a 4.9% return with a guaranteed profit of 2.3% as well. Okay. Okay, so sorry, this is the insurance tool. When I have an unrealized gain, I look to lock in first before selling a call against it. I want to try to lock in that protection first here. And then, as Sam mentioned, I want to see if there's an opportunity to do something else before just selling a call and capping the gain in a bullish market. All right? Okay, Bill has a more advanced question. That's quite all right. Now, he says if if you trade outright longs and want to minimize theta, is there a way to figure out how to minimize the cost of rolling to a later month? Well, again, you know, the portfolio tools show that as if you have a gain in your long call position and the stock continues to move up, it would show you rollout opportunities of rolling the call up and strike to maybe maximize the loss on the position. Or if you roll up the call, you might not have any exposure on the long call position depending on the gain that you have. As you're tracking positions in the portfolio, I don't think I have any open here, I'm sorry. I know I don't have any open here, but let's go back. Okay, let's go back. There is a view here. Apologies, I'll go there again. There is a view in the portfolio for the Greeks view. Now this only shows you your open positions, but you can gauge the theta, and you can see the theta on the option chain, but in reality, I don't think I'm overly concerned with theta when I'm looking to roll long calls. I understand that you are, Bill, and that's perfectly fine. There's nothing wrong with that. I'm thinking about some of my calls, and I don't know if I would want to do that on that situation if I wanted to pay that. You said you want to roll about 25 days before expiry. That's tough. Now you have kept some of your theta decay. All right, let me take a step back. One step back real quick. I know what I want to say. I'm just thinking of a way to illustrate it. Okay. That's too much. Okay. Let's say I didn't have one in my head there, but let's say we did this. April, it's at 310. Let's say that on that first move on Panera Bread that we saw, we bought the 290 for $10. Okay, so we bought the April 290 for $10. I know we're in 20. Yeah, let's go to here. Oh, maybe not. Yeah, it's good. That's good. So let's say I bought that for $10 when the stock had just moved up to 285, 280. Okay, before the big move to 312. Okay, so paid $10, had $1,000 invested in it. Okay, now let's go to the option chain again for Panera. And look at the call chain one more time. And now I got to add a column, so bear with me, ladies and gentlemen. I'm going to go choose columns for the call info. Oops, sorry, folks. We're going to look at theta. Oh, why not? Throw gamma in there as well. Let me reorder the columns too. I apologize. I just want to put these next to the delta. Not that that's very relevant, but at least they're all in the middle of the page so we can see them. The theta is more important, so I'll actually put that before our delta. Let's save that up. All right. So, Bill, here's what I would do. I've got this long call at the 290 strike, I believe I said. Yeah, 290 call. Here's what I purchased. It's got a little bit over 100% gain on it. Theta is pretty low, 0.0075 for 14 days. Okay, so my remaining theta on this is very small. Now let's go ahead and I'm going to check the box. So I'm going to check the box on the left-hand side to hold April. And let's open up May. So I probably want to roll up here to sort of the at-the-money strike, maybe the 310 or so, or maybe go up to this position, the 310 or the 305. Maybe you even want to stay at 290. But you see the thetas here, you're going to face this. The lowest theta you could get to that's even is the equal strike because it's so deep in the money. Okay, if you want it to roll to a higher strike, you're going to have to be rolling into higher theta. It's inevitable. You can't avoid that if you're going to a higher strike or going from an in the money to an at the money, or potentially from the out of the money to an at the money if the stock fell against you. Okay? So with the scenario here that you've got it at 0.075, of course the in the monies would still have that, but this roll doesn't help you. It's a lateral roll just to give you more time, keeping the same strike. So where was I going with saying that I don't pay attention to theta? Well, I've got this large enough gain in my option. What do I want to do? I think there's more upside, but I don't want to have any more risk on the position and potentially maximize my return. So what I'm more focused on is selling this here. We'll call it 22 to 24, so let's say we get $23 for it. Okay, so now we have profit of $13 on a $10 investment. And take that $13. Let's say I buy a 300 call. Now let's say I take half of that. We're going to buy the 305 call for $8, so more than half of that. Okay, so I have $18 invested total, but I've already taken 23 out. What does that leave me with? It leaves me a guaranteed profit of $500. It also gives me more upside if it continues to move up in price. If it goes up to 325, I'm realizing a higher profit. Right now I'd only reach 1,300. I could realize more. So by doing this, do I guarantee that I'm making the $1,300? No, I'm guaranteeing I'm only making 500 of that, but that's even if Panera drops back down to 270 or 275. If it stays the same or moves up, we're close to a $900, maybe a $1,000 profit, close to the 1,300 we're at now. Okay, but again, this is a position that now can change, no risk. I'm still guaranteed to get a profit by continuing the trade, regardless of what happens. And I could make a higher percentage return if it continues up. Okay, so just rolling up the long call. As far as theta concerns, this would be a disaster. If you would analyze theta or potentially even gamma, you're buying to close a 0.0075 theta and you're rolling into a 0.0333. Right, so this is an extreme increase in theta, but on the position, you could still realize a higher profit if it continues to move up. If it stabilizes, yeah, you're not going to realize that profit, and if it falls, you're going to miss out. So what's the lesson? Well, depending on how deep in the money you are and where the stock had moved, trying to control the theta might not be in your best interest. Depending on your outlook, if you're still bullish on the position, but you want to make sure that you still take advantage of higher gains, but you don't want to risk anything, move the put up. Even though the theta looks disgusting as far as a theta roll, because you're buying into much more theta, you could still have a more profitable position if it does continue to move up. Now, I'm not projecting that Panera is. I'm not saying you should be projecting that Panera is. I'm just saying that that's a different structure. This is what I tend to look at. Again, my trading plan without the concerns of buying into higher theta, selling into lower theta, selling to higher theta, I should say, or buying into lower theta. Because if it's moved in your direction that you wanted for a long call, if you're looking to roll it, the only way to keep theta kind of even is a lateral move. And that doesn't give you much of anything, because if I move from the 290 coming up to April to the 290 to May, I'm going to be paying more money. The time value is going to be an increase. I'm not going to gain time value by rolling a long call. I'm going to be giving more time value to stay in the trade, and thus more theta as well. And that's where we're going to put our position in. Okay. All right. Patrick says, married puts look like no-brainers. They work very well for me in my account in the time I dedicate to trading. And Patrick follows it up with, what % of your trades are married puts? For the last 8 years, 9 years almost, since about 2007, almost 10 years now, wow, 2007, 2008, radioactive trades, the married puts represent 50 to 60% of my options trading capital. And I didn't start that way. It really came out after about a year and a half or so after starting to trade them. The reason why I keep it at 50 to 60%, I've been trading since 2001. Many of you are more experienced than I am as far as how many years you've been trading options, but remember, I'm educating and doing this and talking to customers day by day. But in any case, the returns I've seen in my radioactive trading portfolio, the married put portfolio, have outperformed what I saw with a covered call portfolio I traded in my account on similar, if not the exact same stocks, or the same over a 2 to 3 year period. Cash secured naked puts, the married puts outperform them. Credit spreads, absolutely. Calendar spreads as well. Standard collars have come close. But for the amount of time I spend on trading that I'm actually able to trade my personal account, the married puts, radioactive trades have outperformed what I started in the first 6, 7 years of trading with covered calls, cash secured naked puts, bull put credits, bear call credits, iron condors, diagonal spreads, calendars, double diagonals. So over time now, right now it's about 48% of the capital I have allocated to trading options is in the married puts radioactive trades. I just did this the other day because a customer, I had 5 questions in a row about it. So I looked at it was 48%. I might buy a new position the next week, post it for the Fusion subscribers at Radioactive Trading, and it would go up a little bit higher. Right now, it's just 50%. 48%, my apologies. And then I've got about another 15 to 20% of my trading capital is allocated to long collars. About 15 to 20% is allocated to calendar calls and calendar puts, not double diagonals, but calendar calls, calendar puts, diagonal spreads. And then I do trade credit spreads on the broad-based indexes, usually about 10 to 15% of my trading capital. I've pulled off of that because the last 3 to 4 weeks I've been allocating maybe about 12, 15% of my trading capital to very short-term 3 to 4 day long straddle or long strangle trades on stocks that have earnings coming up. So, if it's a Monday and I see there's a stock that has earnings coming out on Wednesday, I'll buy the Friday expiration series 3-day out, 4-day out options trades. They actually require more management than I thought originally because you have to get in first thing in the morning after the event to try to get the best price for the long call or the long put to close out of that position. Okay. Yes, Patrick, I'm sorry. And this here, when we're talking about rolling a long call position, is assuming a nice gain that you have. And in general, most investors I've talked to over the years who trade long calls have a goal of at least their trigger point to close the position is usually close to 70 to 100%. So if I paid $2 for the call, I probably bought it 3 months out in time. My trigger point to close it is if the stock that or the option I paid $2 for goes up to 350, 360, or 370, getting closer to $2. So that's what we're kind of looking for. But then you say, wait, it's moved as I expected, and I have this near 100% gain on the position. How do I manage it? Because I think it's higher. Now, of course, that doesn't mean I'm saying that long call investors will always realize that return. I'm saying that's their trigger. Most long call investors I've spoken to over the years look for that type of gain as their trigger point. Most of them see that trigger point only about 40 to 45% of the time. The other positions they end up managing on a shorter term or long-term basis to either minimize a loss that they took because they don't want to take the 100% loss if the stock really moved against them, or try to manage the position to try to get a little bit better return. If they saw a 10% return on their option, they might try to get it to a 20%. And that might not be that much of a return. Even if you bought 10 contracts of a call at $1 and the premium moved up to 110, well, that's a 10% return, isn't it? You didn't make a lot of money though, but hey, it's a 10% return over a 10-day, 15-day, 20-day trade. All right. Okay, let's see here. Let's do some things here. All right. That's funny. Sam, I like that. It's I have a rule. Sam says I have a rule when I sell calls or puts not to lose more than 100%. It's a good rule to have. Yeah, when you're selling calls, you can take a loss much larger than what you realized. Okay, let's see here. Looks like the last question we have. We are at 10 minutes over, but that's okay. I'll take this last question here. It's from Isaac. It says, I have a bear put debit spread on SPY. Issued a week ago. It's May expiration. Sold the 230 put, bought the 235. That would be our bear put spread. Stock is moving sideways. Will you make an adjustment at this point? If so, how will you do it? Okay, well, I don't know your debit, but I'm assuming your debit was going to be around, for a 5-point spread, it's going to be around 450, 420, somewhere in that range, okay? So we're going to go on that. Let's go SPY. Now, I'm going to have to assume standard May expiration. Isaac, you didn't give me a weekly, so I'm going to assume standard May, 42 days out. All right, we've got a bear put debit. It's looking not so good. A bear put debit consists of selling a lower strike option, a lower strike put, and buying a higher strike put. It's a parity trade to a bear call credit spread, except this time we're doing it at a debit. So let's say because this put is deeper in the money, at the time it was, let's say the stock was at 225, SPY is at 225, I expect it to stay below that. We may have entered this position by selling to open the 230 May put for 240 and buying this for 690. Okay, does that look right? Yep. All right, so in this case I've got a debit of 450 on the position. I paid 450. Now remember what happens to a put that's in the money. If the stock stays below 230, this is my short put, I may be obligated to buy shares of stock at 230. But I've also purchased the right to force someone to buy those shares of stock at 235. So if this closes below 230, I liquidate out of the position, I get 5 points back. I paid $450 in, so I'm looking to make $50 on a $450 investment. It's an 11% return on the position. And this position now is not in good standing. The stock is sideways, as you mentioned, but it's holding right at 235.20. So what are your options? Okay, well, if you're still bearish, remember you have 42 days to go to expiration. You can hold, do nothing, and wait to see how this reacts. Okay, so you want to see it drop down to maybe 233, 232, 230. That's what you're looking for. So hold and do nothing, wait to see if the stock pulls back and you get more of a profit. During our credit spread webinars, and I think we discussed this 2 weeks ago on the open discussion, if I'm in a bear call credit and the stock moves above my strike, I may try to convert the bear call credit into a bull call debit with what's called the pendulum adjustment by swinging the long option down. Well, here's another idea. You may be able to use the pendulum adjustment on this position to sell to close the 235 and buy to open a 225 put. So now you're in a bull put credit spread with a stock trading at 235. Instead of rolling both legs, just roll one. That's what we call the pendulum adjustment. Now in order for this to work, the numbers have to work out. Essentially the price of the roll has to be less than the difference in strike prices. Let's go to May 19. And what I would have to do here is sell the 235 for 320. I'm going to buy a 225 for 115. So 320 and 115. Okay, so we're moving the option that we bought. We're going to sell to close it for 320. I can tell this is already not going to work. And we're going to buy this one for, what did I say, 114, 115? Let's put it at 114. All right, so what happens now? Yeah, I converted it to a bull put credit spread, but the numbers aren't there. So this all would do is lock me into a loss. Might be able to get a better position by just going to the 229 or the 228, but the pendulum adjustment typically works best if the stock is trading right between the two strike prices, not above both. That's a little tough to get that to work, okay? All right, so here you're at a loss. Now, what are your other options? You could convert the short to the long to create a bull put spread, but that wouldn't work. See, if you bought to close the 230 and sold the 240 to create a bull put spread going higher, now you need the stock to keep going up above 240 in order for that roll to make sense. There's no guarantee it would come out to a profit. Do you want to buy back the position? Liquidate the bull put spread, your bull call, bear put, sorry, one more time. Too many strategies in my head. Do you want to liquidate the bear put spread you have now and move it up in strikes? Well, you've got so much time. It's 42 days away. You want to let some of this time value work in your favor. Okay, it has gone against you. I'm not projecting where the market's going to go next week. We can't do anything today anyway, so I'd say wait till Monday or Tuesday of next week, see where the market goes. If it starts to pull back into this range, we may be able to do adjustments at that time. But in this case, right now, I think rolling is premature. You still have 42 days out. That being said, I know this might be tough, and I'm not saying tough because you don't know options at all, and I'm not saying it's tough because you can't comprehend it. It's tough because it's going to be spoken in reverse. So here's what I'm saying. Go to free webinars, powerup.com/webinars.asp. Up here at the top, you can just go to powerup.com/webinars.asp. And in the options strategies section, there is a webinar on managing your spread positions. I discuss managing debit spreads and credit spreads in this webinar. In addition to that, there's a full webinar on managing your bear call credit spreads. That's not what you're in, but you're in a parity trade to a bear call credit spread. So some of the ideas here in relation to the profit and loss chart and adjusting a bear call credit would apply to adjusting a bear put debit. Unfortunately, you're going to have to think slightly backwards, okay? Because instead of dealing with calls, you're dealing with puts. But you would have sold the same strike on the bear put debit that you would have sold on the bear call. You would have bought the same strike in the bear put debit that you would have bought on the bear call. They are parity trades. So the rolling of one or the rolling of both, this webinar here on managing your bear call credit spread, will show you what you'd expect if you just rolled the bear put up to the next strikes and further out in time. What if you changed it and converted it into a bull put credit spread from your bear put debit spread, and so forth. But the profit and loss charts would look the same. The terminology is going to be different in this webinar. That's what I meant by it might be a little bit confusing. But the profit and loss chart views would be the same. The ideas of what you'd expect when to roll will be the same. You're just applying it to a debit spread instead of rolling a credit spread. But again, here, it's a full webinar on managing your spread positions. You'll be able to just go through it. You'll see that I'll start off talking about managing a bull put. You can fast forward through that, and then maybe you'll hit managing a bull call debit. You can move forward from that, and oh, here's managing a bear call. Move through that, and then you'll see managing the bear put debit. There'll be some ideas for you with the managing your spread positions. This is a public page, powerup.com/webinars.asp. You can access that at any time. Go under option strategies, managing your spread positions, managing your bear call credit spreads. All right. Well, ladies and gentlemen, I think that was the last question we had here that I saw come in. If anyone has any last-minute questions, you can go ahead and try to send those in now, but we are, of course, at about 5:45 Eastern Time as well. I just want to remind everyone, of course, if you haven't done so already, those of you that might be joining us for the first time or just checking out one of our webinars, remember, you can take a 14-day free trial at any time. Just go to powerup.com, put in your first name, last name, and email address, and you'll have access to Power Options for 14 days, no credit card required. After that, we do have different levels of service. Our end-of-day service, it's only $40 per month. You have access to all the search tools, the portfolio tools, and the tools we looked at today. That's only $40 per month, but again, your data is only updated at the end of day. We do offer a 20-minute delay service. That's $60 per month. So you have more access. You still have access to most of the tools, but the data update is every 15 to 20 minutes. So every time you run a search or look at your portfolio, it's only about 15 minutes delayed, 20 minutes delayed. We do, of course, offer a real-time service. It's more expensive due to the exchange fees that they keep increasing year by year from the NASDAQ, the NYSE, and so forth. So our real-time service is $120 per month. And then, of course, you can get the full access to the historical tools on top of the 20-minute delayed or on top of the real-time for an increased price as well. Now, next week, of course, if you want more free information, remember, you can check out the blog at any time, blog.powerup.com, or you can go to radioactivetrading.com and click on the blog and scan through some of our articles and white papers on adjusting and managing the married puts and the radioactive trading techniques. As mentioned, at any time, you can go to our webinars page, powerup.com/webinars.asp. And, of course, we're also all over YouTube with different archive presentations. You can just go to YouTube and look up Power Options, and you'll be able to access the videos there as well. Next week, we will have some more presentations. I'm thinking Tuesday we'll have a discussion introducing radioactive trades. Haven't posted it yet, but next Wednesday at 12 noon, we're going to have our final follow-up on calendar spreads, the Managing Your Diagonal and Horizontal Calendar Spread webinar. That'll be Wednesday at 12 noon Eastern Time. And, of course, next Thursday, I think I'm going to talk about trade comparisons related to the radioactive trades and other positions as well. But you'll see that available when you check out Power Options or go to the webinars page. You'll see the next live webinars posted as well. But remember, if you have a question at any time related to trading, trade management, using the Power Options tools, send us an email anytime to support@powerup.com. You can also reach us at support@radioactivetrading.com. Or remember, you can also call us during market hours. There is a toll-free number. It's 877-992-7971. Or if you live outside the continental U.S., you can reach us at 302-992-7971 as well. And, of course, those of you that are currently on a trial or are subscriber to Power Options, remember, you can schedule one of those free coaching sessions at any time. It's essentially a 35 to 45-minute phone conversation with myself or Ernie. We will walk you through the tools on the site and answer any questions that you have on a one-on-one basis. All right. Well, ladies and gentlemen, thank you for joining me this evening. I hope you all have a fantastic weekend, and I hope to see you all coming up in the next week. And of course, as I said, I hope you all have a fantastic weekend. Happy trading. We'll talk to you soon. Good night, everybody.